All right, let's dive right in. We're talking about principle number one for responsible investment. And honestly, this thing is a huge shift in thinking. It's all about moving beyond just the plain old balance sheet, you know? It's about actually baking in those environmental, social, and governance, what we all call ESG, issues right into the heart of how investment decisions get made.
So to really get a grip on this, we're going straight to the source. Everything we're covering here, it's all based on materials from the Principles for Responsible Investment, or PRI for short. And what's cool is that this isn't some academic theory. It's a framework built by investors for investors. So it gives us a really clear window into how this stuff actually works out in the real world.
So that really brings us to the million-dollar question, right? We hear this term ESG thrown around all the time, but what does it actually mean when the rubber hits the road? I mean, how does an investor look at something like a company's water usage or its labor practices and turn that into a cold, hard financial decision? Well, that is exactly what we are going to unpack today.
Okay, here's how we're going to break it down. First, we'll talk about why ESG matters so much right now. Then we'll get into the core commitment investors are making. After that, we'll look at the actual toolkit they use, and finally, we'll see how it all gives us a more complete picture.
All right, first things first, why ESG and why now? I mean, seriously, how did this whole responsible investing thing go from being this kind of niche boutique strategy to a central part of pretty much every financial conversation? Well, it turns out it wasn't just one thing. It was a perfect storm, really, a powerful mix of forces all coming together. You know, a really tragic story from 2019 kind of brings this all home. The dam collapse at a Vale mine in Brazil, it was just awful, a horrific human and environmental disaster, but it was also a financial catastrophe. We're talking over $7 billion in settlements, and it just crushed the company's value. It's such a powerful reminder that these ESG risks, they aren't abstract. They are real-world risks with massive financial consequences. And that disaster really shines a spotlight on what's driving this whole shift. There are basically four key forces pushing this forward. This idea of financial materiality, the legal concept of fiduciary duties, a ton of new policies and regulations, and of course, simple client demand. Put them all together and they are completely reshaping the investment world. So let's start with that first one, financial materiality. This is so important. This isn't about some vague feel-good stuff. An ESG issue is financially material if there's a real, measurable chance it's going to hit a company's bottom line, period. Think about it. Climate change affecting a farm's harvest? That's a financial risk. Poor labor practices leading to a factory shutdown? That's a financial risk. It's tangible. And that idea connects directly to the second driver, fiduciary duty. Now, this is a big legal and ethical thing. For ages, it just meant you had to act in your client's best financial interest. But here's the twist. The very definition of best interest is changing. If ESG issues can actually impact returns, and we've just established they can, then suddenly ignoring them isn't just a bad strategy. You could argue it's a failure of your most basic duty as an investor.
Okay, so with all that in mind, what's the actual promise here? What's the core commitment an investor is making when they sign up for this?
It boils down to this one single powerful sentence. This right here is Principle 1. And what's really key is to notice it's a commitment to change the process. It doesn't say you must invest in this or you can't invest in that. It says that ESG factors have to be part of the analysis. It's about weaving this way of thinking into the very DNA of how investing works.
All right, so that's the big promise. But how do you actually do it? What are the real, practical tools investors use to take ESG from just an idea and put it into their daily work? Let's pop open the toolkit and take a look. Okay, so there are basically three main tools in the box that form the backbone of all this. You can think of them as different wrenches for different jobs. You've got screening, ESG integration, and thematic investing. And an investor might use just one of these, or hey, maybe a combination of all three.
First up is screening. This is probably the most straightforward one to understand. It's basically like applying a filter to all the possible investments out there. You set up some rules, and based on those ESG rules, you decide what's in and what's out. And this screening approach really comes in two main flavors. On one hand, you have negative screening. This is the classic avoid list, like deciding you're just not going to invest in tobacco companies, for example. But then you have the flip side, positive screening. This is where you're actively looking for the good guys, the companies that are leaders on certain ESG issues, like a company with amazing green tech.
Okay, tool number 2 is ESG integration. And this one goes a lot deeper. See, it's not just a one-time filter like screening. Integration means these ESG factors are woven right into the fabric of the day-to-day financial analysis. It's a constant, ongoing process of asking, hey, how might this company's carbon emissions affect its future profits? And the whole point is to get better risk-adjusted returns in the long run.
And that brings us to our third tool, thematic investing. Now, this is where the whole mindset kind of shifts. It's not just about dodging risks anymore, it's about actively hunting for opportunities. This is all about investing in big, long-term trends related to sustainability. Think about the massive global shift to renewable energy, or all the new tech in sustainable farming. That's thematic investing.
So there you have it, our toolkit: screening, integration, and thematic investing. Now let's see how these tools actually get used in the real world across different kinds of investments and how they help build a much more complete picture.
And what's really cool is how versatile these tools are. Like, if you're investing in public companies on the stock market, you can use your shareholder votes to push for change. If you're in private equity, where you have a lot more control, you might literally take a seat on the board to help build out their ESG strategy. Even with something like bonds, investors can now write ESG requirements right into the loan paperwork. It's all about using the right lever for the right type of investment.
So when you pull it all together, it leads to this one really important idea. The whole point of Principle 1 isn't to create some separate, special category of ESG investing. No. The point is that in the world we live in today, this complex, interconnected world, a financial analysis just isn't finished without considering this stuff. Which leaves us with a final question, really. In a world with so many complex risks and opportunities, can any investor truly afford not to?